Good morning and welcome to Storm Stock Solutions. I'm Grant Mercer. We're heading into the year's last full week of trading, and stock futures are pointing modestly higher after a rough Friday that saw tech and the AI darlings take a hit. Rotation, not panic, is the theme as we get set for the opening bell. Let's start with today's key drivers. According to reporting from MarkWatch, U.S. futures are up in early trade, trying to claw back some of Friday's losses. The big story underneath the surface is that rotation trade out of the high-flying AI and mega-cap tech names and into more traditional areas of the market. That's a classic late-year dynamic. Traders lock in gains where they've made a lot of money and redeploy into laggards or more defensive spots. On the macro front, there are two overlapping narratives to watch. First, politics and the Fed. MarketWatch highlights comments from Kevin Hassett, a top economic advisor to former President Trump, signaling that if he were to become Fed chair, Trump would have no weight on rate decisions. Whether you take that at face value or not, it underscores that the market is already gaming out what Fed independence looks like under future leadership. That keeps rate expectations and Fed credibility squarely in focus for longer-term investors. Second, we're in that stretch where a few key data points can really stir the pot. As Isabel Wang at MarketWatch notes, a delayed November jobs report and an important inflation reading are still on deck and could inject volatility into this final push of the year. So even if this morning looks calm, traders know that later this week the macro calendar can flip the script quickly. Now, where is their strength, or at least interesting positioning as we head into the open? One under-the-radar theme that keeps resurfacing is real estate and household balance sheets. There's a widely read MarketWatch personal finance piece about parents and adult children navigating investment properties and rent. Not a ticker-specific story, but the popularity of these housing and property headlines speaks to how much capital headlines is tied up in real estate. For traders, that often translates into a watchful eye on home builders, rates, and financials connected to the housing ecosystem as we go into year-end. On the flip side, let's talk about risks and weak spots. The fragile area right now is still big tech and the AI complex. Friday's session saw those leaders lead to the downside. Futures action suggests some stabilization, but rotational pressure can be persistent. When managers de-risk into year-end, they often sell the winners first. Add in the uncertainty around the future Fed chair and interest rate path, and growth names with stretched valuations are naturally areas to handle with care. If the upcoming jobs report or inflation print comes in hotter than expected, growth and rate-sensitive names could be first in the line of fire. There's also a broader stir-up risk referenced in that MarketWatch piece on the last trading push of the year: thin holiday liquidity. As volumes drop, price swings can get exaggerated. Professional traders will be very aware of that. Tighter stops, smaller position sizes, and a close eye on intraday headlines tend to be the playbook in this kind of environment. Let's move to the sleepers. The stories that aren't driving the tape yet, but could matter more as the day unfolds. First, iRobot. According to Mike Murphy's report at MarketWatch, the Roomba maker has filed for Chapter 11 bankruptcy and will be taken private by a pair of Chinese companies. The stock itself is headed off the public stage, but the themes it touches, Chinese ownership of U.S. consumer tech brands, regulatory scrutiny, and the boom and bust cycle of once-hot hardware names, are all things longer-term investors will be chewing on. It's also a reminder that not every consumer robotics or smart home play is destined to be an AI winner. Another sleeper angle is healthcare and policy. Jamie Lee at MarketWatch notes that today is the deadline to enroll in Affordable Care Act plans if you want coverage to begin January 1st, and that some of the subsidies that made those plans cheaper are expiring for 2026. Individual signups won't swing the S&P 500 today, but health insurers, hospital chains, and managed care names are all part of a sector that's very sensitive to policy and subsidy changes. Professionals might be flagging this as a longer-term input into their healthcare theses, and quietly there's a drumbeat of stories about household vulnerability and retirement decisions. From couples asking, where are we vulnerable? With paid-off mortgages and IRAs, to debates over when to claim Social Security or how to handle family wealth. Those kinds of pieces don't move futures, but they tell you a lot about sentiment. Cautious, income-focused, and very tuned in to stability. That often shows up as underlying support for dividend payers, utilities, and quality franchises when volatility picks up. So to sum it up, going into the open, futures are pointing higher. attempting a rebound after Friday's tech-led sell-off. Rotation out of AI and megacap growth into more traditional sectors is the main storyline. Macro risk from a delayed jobs report and key inflation data is lurking later in the week, and political chatter around potential Fed leadership is adding another layer of uncertainty. Under the surface, stories in real estate, healthcare policy, and consumer finances are quietly shaping where capital might flow into 2026. We'll be watching how that rotation trade behaves in the first hour, whether tech can find its footing, and how it's Fed sensitive. The tape is to any new headlines around the Fed or those upcoming data releases. I'll be back with intraday updates once the market gets moving to keep you dialed into the shifts in real time. Remember, this is information and education, not personalized financial advice. As always, I'll be here to keep clarity through the chaos of these markets. On behalf of Storm Stock Solutions, I'm Grant Mercer. Stay sharp, stay steady.